Have you ever wondered how you really get inside a complex, multi-billion-dollar organization? Not just the headlines, but really understand it. Today we're doing just that. A deep dive into Energy Transfer LP, one of the real giants in energy infrastructure. You've probably seen their logo, that swirling E, right? On pipelines, maybe terminals. We're going straight to the source. Their recent Form 10Q filing for the quarter ended June 30, 2025. And trust me, it's way more than just dry numbers. It's a gold mine.
It really is. And our goal today, well, it's to pull out the key insights for you, give you a shortcut, basically, to understanding Energy Transfer's latest performance, their big strategic plays, and, importantly, all the legal and regulatory stuff they're navigating. Because that stuff constantly shapes their future. This dive should give you, hopefully, multiple viewpoints, maybe a few aha moments, help connect the dots.
Okay, let's unpack this then. Energy Transfer LP, huge presence for anyone not super familiar. What exactly do they do, and what are we talking about in terms of sheer scale?
Right. So Energy Transfer LP, it's a Delaware partnership based in Dallas, Texas. They operate mainly in the U.S., and they break their business down into 8 segments. Think of them as the arteries of the energy system. You've got intrastate and interstate natural gas transport and storage, midstream operations, that's processing and gathering NGL, natural gas liquids, and refined products transport. Crude oil transport, plus their investments in Sunoco LP and USA Compression Partners, or USAC. And then there's sort of an all-other bucket for gas marketing, compression, that kind of thing.
8 segments. Wow. And the size?
Size-wise, as of June 30th, 2025, we're talking total assets over $125 billion.
Like 125 billion. Okay,
Yeah.
that definitely paints a picture. Colossal is the word.
It really is.
So let's get into the financial health then. Looking at that 10Q, the headline numbers, net income actually went down for the quarter and the first 6 months of 2025 compared to last year. What's going on there? What does that tell you straight off?
Yeah, you picked up on the key thing right away. For the 3 months ending June 30, 2025, net income was $1,458 million. That's down from nearly $2 billion in 2024. And for the 6 months, $3,178 million, down from about $3,684 million. So a noticeable dip. But, and this is where it gets really interesting, while that net income figure dropped, their adjusted EBITDA, which is a really important measure of core profit, especially for MLPs, it actually increased.
Okay.
For the 3 months,
Adjusted EBITDA went up to $3,866 million from $3,760 million. And for the 6 months, it climbed to $7,964 million from $7,640. It's a great question, and it really highlights something critical about MLPs, like Energy Transfer. Net income, it can get pushed around by one-off accounting things. The main reason for that drop in net income, it was a huge non-recurring gain they had last year in 2024. About $598 million from Sunoco LP selling some assets in West Texas. That gain just wasn't repeated this year.
Okay. So a big one-time boost last year makes this year look lower by comparison.
Exactly. Plus, they also saw some increases in operating costs, depreciation, interest expense this year. Normal course of business stuff, but it adds up. But the adjusted EBITDA increase, that strips out things like depreciation and those one-off gains or losses. It gives you a clearer view of the underlying operational cash flow.
Right.
So yeah, the accounting net income dipped because last year's comparison was tough and costs went up a bit. But the rising adjusted EBITDA, that's actually a strong sign. Their core business pipeline, storage, midstream, it's generated more cash than before.
And for the 6-month number, didn't you mention there was another non-recurring item this year too? Something about $160 million?
That's right. Yeah, that was related to Winter Storm Uri way back in 2021, a final settlement or payment connected to that extreme weather event. So another kind of one-off thing hitting the net income line. But here's what's really interesting, especially if you're a unit holder looking at this. Despite that overall net income decrease, the net income per common unit, basically, what each share or unit earn for the 6 months ending June 30th, 2025, it actually went up slightly.
Up, really?
Yeah, to $0.68 per unit from $0.67 the year before.
So even with the headline net income down, the slice of the pie for each investor actually grew a tiny bit.
Precisely. It shows how your direct share held up or even improved slightly, even while the bigger numbers were being influenced by these, one-time accounting things.
Okay, that context is crucial. So operations strong, but accounting makes the net income look weaker. Got it. Now looking forward, Energy Transfer isn't just sitting back. They're making some big moves, right? Especially through Sunoco LP.
Oh, absolutely. They're definitely in growth mode. The first huge one is the Parkland acquisition. Sunoco LP is planning to buy all the shares of Parkland Corporation. It's a cash and equity deal valued at roughly $9.1 billion, and that includes taking on Parkland's debt.
$9 billion. That's a major deal.
Yeah.
When's that supposed to happen?
Expected to close in the fourth quarter of 2025. And as part of it, Sunoco LP is planning to repurpose a subsidiary into something called Sunoco Corp. LLC. That entity will become a publicly traded corporation.
Interesting. And the strategic point of this.
Big picture, it's a massive expansion of their refined products distribution network, really boosts their footprint across North America. Then there's the Tankwood acquisition.
The Tankwood. Okay, what's that?
Back in March 2025, Sunoco LP agreed to buy Tankwood GmbH. It's a German company. The price is about $500 million, so maybe $586 million US, including debt. Tankwood owns and runs 15 fuel terminals in Germany, plus one in Poland.
Germany and Poland. So they're expanding internationally too.
Exactly. This is a significant step for Sunoco LP outside North America. That deal is expected to close in the second half of 2025.
And it wasn't just those two big ones, right? Weren't there some smaller deals too?
Yeah, good point. They're not just making huge splashes. Sunoco LP also did some smaller tactical acquisitions in the first half of 25, about $17 million for fuel equipment and inventory, and another $105 million for 151 fuel distribution consignment sites.
So constant growth, both big strategic plays and smaller bolt-ons.
That's the picture. They're clearly focused on expanding their reach and their network. But, building this kind of empire, it's not just about spending money. It means dealing with a whole lot of rules and regulations.
That's a perfect segue. Let's talk about that regulatory maze for a company like Energy Transfer. Regulatory decisions must be huge. What are some of the biggest, maybe most interesting regulatory challenges they're facing right now based on the 10Q?
Okay, well, one significant development is the One Big Beautiful Bill Act, or OBBBA, signed into law July 4th, 2025. This law permanently brings back 100% bonus depreciation for certain property, and it changes the rules around deducting business interest expenses for federal taxes.
Right, so tax law changes. What's the impact for Energy Transfer?
Well, the big question is a long-term effect on their taxes. Energy Transfer expects it will let them defer a good chunk of tax payments for their corporate subsidiaries into the future, though they noted they don't see a huge impact on their overall income tax expense. It's more about timing. Then there's the ongoing saga with FRC rate setting, specifically the double recovery issue.
Double recovery, what's that about?
So FRC, the Federal Energy Regulatory Commission, decided that MLPs, like Energy Transfer, can't include an income tax allowance in the rates they charge customers on pipelines regulated using cost of service. The argument from FRC was basically, since MLPs don't pay corporate income tax themselves, they pass income to unit holders, letting them charge customers for that non-existent tax expense was like double recovery.
I see. And how's that playing out?
It's complicated. One of Energy Transfer's big pipelines, Panhandle Eastern, is stuck in a really long rate case with FURC over this. There have been appeals, refund orders. It's a constant back and forth. It just shows the continuous pressure on their regulated interstate pipelines. Every part of their rate calculation can be, and often is, challenged.
Okay, so tax changes and pressure on pipeline rates from FURC. What else? You'd mentioned liquids pipelines earlier.
Right. The world of liquids pipeline rates is also pretty volatile. It's regulated differently. For these interstate common carrier liquids pipelines, FURC uses an indexing method. It's tied to the producer price index for finished goods, PPI-FG, and adjusted each year. Now get this. In July 2024, a court threw out a FERC order that had lowered the index adjustment, that temporarily reinstated a higher rate index.
Okay, so rates went up.
Briefly, because then in October 2024, FERC proposed a new reduction to the index.
Wow, so it's constantly changing, up-down proposals.
Exactly. Constant flux. And these index changes, even if they seem small, can swing revenues by potentially hundreds of millions for a company like Energy Transfer. It's a massive area of uncertainty and regulatory risk for them.
Definitely sounds like it. And finally, on the regulatory front, what about environmental rules? Air quality.
Yeah, that's another big one. Specifically, the EPA's Good Neighbor Plan. This came out in 2023. It's aimed at cutting nitrogen oxide pollution from certain states that affects air quality in downwind states.
For Energy Transfer, it includes new, stricter emission standards for some of their natural gas pipeline engines. Those are supposed to kick in starting 2026.
Okay, stricter
multiple legal challenges, including lawsuits brought by Energy Transfer itself and other industry players. So you see the pattern. Potential for big capital spending due to regulation met with strong legal pushback trying to delay or modify those costs.
Regulation is clearly a battlefield. And speaking of battles, Energy Transfer is also quite active in the courtroom, right? Beyond just fighting regulation.
Oh, absolutely. They're no stranger to litigation. These legal fights can drag on for years and cost a fortune. Let's look at a few prominent examples from the 10Q. First, the one everyone knows. The Dakota Access Pipeline, or DAPL, saga.
Still ongoing.
Very much so. Long-running lawsuits from several Native American tribes challenging the permits, especially the easement under Lake Oahe. You might remember there were court orders trying to vacate the easement, even shut the pipeline down completely. But the appeals court ultimately overturned the shutdown order. They did uphold the need for a full environmental impact statement, an EIS.
So the pipeline is operating now.
Yes. Crucially, DAPL is still operating while everyone waits for that final EIS. That's expected around December 2025. And just to add another layer, the Standing Rock Sioux Tribe filed another lawsuit in late 2024 trying to shut it down again.
And what happened with that one?
A district court dismissed it in March 2025, but predictably perhaps, that dismissal is now being appealed.
It just never ends, does it? The persistence is incredible on both sides.
It really is. It shows the deep-seated nature of these conflicts. Okay, next example. The Klein class action in Oklahoma.
Klein class action. What's this about?
This involves a subsidiary, Energy Transfer R&M. The claim is they failed to make timely payments for oil and gas proceeds to royalty owners and didn't pay the required statutory interest on those late payments.
Okay, royalty payments. What was the outcome?
Well, it's been complex. A trial court initially hit them with $75 million in actual damages and $75 million in punitive damages. Then there were appeals about whether the judgment was final. Long story short, a new final judgment came down in October 2023. The total now, about $104 million in actual damages plus the $75 million in punitive.
Wow. Over $175 million total. Have they paid that?
No, they've appealed the whole thing. Oral arguments happened back in November 2024. So
It's still working its way through the appeals process, but it's a stark example of how historical operational issues, especially with things like interest penalties piling up, can lead to really significant...
the Oklahoma AG filed two lawsuits, one in 2024 and one in 2025, against Energy Transfer and some subsidiaries. They're alleging things like antitrust violations, breach of contract, unjust enrichment, basically claiming improper conduct in the natural gas market during that extreme cold snap in February 2021, price gouging accusations, essentially.
Right, that was a huge event for the energy markets. Where do those cases stand?
The first case, filed in 2024, survived motions to dismiss back in January 2025.
So that one's moving into the discovery phase, gathering evidence. The second case, from 2025, is facing similar motions to dismiss. A hearing on that is expected late summer or maybe early fall.
It really sounds like a significant chunk of their focus, maybe even management time and resources, must be tied up in dealing with all these regulations and lawsuits. From your perspective, what does that constant state of, well, defense mean for a company? Does it stifle innovation or affect their image?
That's a really insightful question. It's definitely a major factor. It's not just the legal bills, which are substantial, as you can imagine. It's the management distraction. Time and energy that could be focused purely on strategic growth or operational improvements inevitably gets diverted to managing litigation and regulatory filings. And yes, it absolutely impacts public perception and stakeholder relations, particularly in an industry that's already under a microscope for environmental and social issues. It's a constant high-stakes balancing act they have to perform.
A balancing act, yeah. So with all these moving parts, the big acquisitions, the regulatory fights, the court cases, how is Energy Transfer actually deploying its capital? What are their plans for future investment?
Well, despite all those challenges, they are still investing heavily. For 2025, Energy Transfer itself, this excludes Sunoco and USAC, they expect to spend about $5.0 billion on growth projects.
$5 billion on growth. Wow. And maintenance?
And another $1.1 billion on maintenance capital expenditures, just keeping the existing massive network running smoothly. Then you add in their subsidiaries. Sunoco LP is projecting at least $400 million for growth and $150 million for maintenance in 2025. And USAC plans about $120 to $140 million for expansion, plus $38 to $42 million for maintenance.
It really does. It signals confidence in their future prospects and the need to keep investing in that vast infrastructure network.
Okay, well, what about the unit holders in all this? With strong cash flow, but also big spending and legal costs, what are they seeing in terms of cash return to them? That's the other side of the coin. On distributions, Energy Transfer announced a quarterly payout of $0.33 per common unit for the quarter ending June 30, 2025. That works out to $1.32 on an annualized basis.
And how does that compare to recent quarters?
It's actually a slight increase. The distribution was 0.3275 for the first quarter of 2025 and 0.325 cents for the last quarter of 2024.
So a gradual upward trend in distributions.
Exactly. That steady, slight increase happening alongside all the significant investment and the legal and regulatory costs, it really speaks to the robustness of their underlying cash flow generation and their commitment to returning capital to investors.
Right. So we've really covered a lot of ground here. We've dived into Energy Transfer LP, look at their financials, the nuance between net income and adjusted EBITDA, their pretty ambitious growth through acquisitions like Parkland and Tanquit. And then spent a good amount of time on the really complex legal and regulatory world they operate in daily. From FARC rates to DAPL to Winter Storm Uri fallout, it's a snapshot of a company in constant motion, juggling a lot.
Yeah, what really stands out, I think, is that dynamic you mentioned, this constant interplay between deploying huge amounts of capital for growth and simultaneously fighting these persistent battles with regulators and the courts. It just highlights how companies in this sector have to constantly balance that expansionary drive with the demands of compliance and legal defense. And these hurdles, as we saw with DAPL and Klein, they can stretch on for years, sometimes even decades.
Absolutely. So maybe here's a final thought for you.
Our listener, to chew on. In an industry that seems to be facing ever-increasing regulatory scrutiny, especially around environmental impacts, pipeline safety, rate structure,